See, so yesterday we were into this topic. Yeah, so here we are. So see, we can think of accounts payable as an implicit source of credit from suppliers. See, what do you mean by implicit source? So first you should know the meaning of implicit and explicit. See, implicit is something which is not described clearly or directly. Okay, but that is to be understood. Okay. So first of all, I'll explain you about explicit. Explicit describes something that is very clear. Okay. Here things are clearly described. That means the terms and conditions are not vague or not ambiguous. There's no confusion. Things are very clear and put in front of you. Explicit, vivid, clear. Okay. But implicit is not something which is like, that you should understand. It will not be said. Okay. Okay. Something which is understood but not clearly described. Okay. And often used as implication or assumption. See, when you apply for a loan to a bank, bank will definitely charge interest on that. Okay. They should not clearly mention to you. Okay. That is understood fact. But there are two things here. They will charge interest. It is understood, but how much they will charge, they have to disclose, right? So implicit, which is clearly described and without vagueness. Or ambiguity. And here implicit is something that is understood, but not described clearly or directly. Why I am explaining this point? Because here you'll come across these two words, and it is implied, I can say, implied or assumed. Okay. Now, so we can think of accounts payable as an implicit source of credit from suppliers. That means it is not that they will tell you that you take the goods on credit from us, but if you ask them, there may be chances that they may not deny even. Okay, so things are not clearly described, but they won't say you can take the goods from us and we are giving credit to you. No, it is you who have to ask. Okay. So suppliers offer payment terms in the form A by B net C. That means let's say 2 by 10 net 30. What is the meaning of this 2 by 10 net 30? You can make the payment in 30 days. You can make the, so pay in 30 days. Okay. You can make the payment in 30 days. But if you make the payment in 10 days, if paid in 10 days, you will get 2% additional discount.
So
that means, yes.
which topic are we doing here?
Working capital. This one, working capital.
No.
Corporate
Okay.
finance.
Yes.
Don't you? Yesterday we started this only, right?
Yes, sir.
Yeah.
Last topic that I wrote was cash conversion cycle. So after that,
Sorry, I'm not able to hear you. Hello. Yeah. Last topic.
last topic that I wrote about was cash conversion cycle. After that, I hadn't written anything.
Yeah, cash conversion cycle we discussed, and we have come here. We were discussing about more cash conversion
Yeah.
cycle, less cash conversion cycle, how we can decrease, increase, and what the businesses usually do when they decrease,
Okay.
like decrease the certain assets or certain liabilities. Or if they extend payables, right? We discussed all that, and then
Yes.
we stopped exactly here, and then now we're discussing this because we are going to find effective annual rate. Okay, now
Okay.
next. So 2 by 10 net 30 or A by B net C means you can make the customer can make the payment to supplier in 30 days, or the buyer can make the payment to supplier in 30 days. But if they make the payment in 10 days, they'll get additional discount of 2%. That is called 2 by 10 net 30. Okay. So in 10 days, 2% discount. If the payment is made in 30 days, you won't get 2% discount. So this is to give some extra additional offer and reduce the margin so that the payments can be collected as early as possible. Okay. So sometimes what happens, you may consider to take the discount and sometimes you may not consider to take the discount. There can be reasons for you to not take this discount as well. That means if let's say if the payment what you are supposed to make, you are not making in 10 days and you are making in 30 days, and this money, if you invest somewhere else and you're getting more, returns than the discount what they're offering, then definitely it is better for you to not take the discount and make the payment, right? But you should get that benefit more than what you are the discount what you're not availing. That means if you are skipping this discount, if you're not availing discount, if you're not taking discount, then the benefit of not taking discount should be more than the cost of not taking the discount. Did you understand?
Yes, sir.
The benefit of not taking the discount should be more than the cost of not taking the discount. So we will first find out the cost of not taking the discount. Okay. Yeah, foregoing the discount for prompt payment. Okay, foregoing the discount for prompt payment amounts to borrowing the money from supplier for C minus B days. Okay, so we will see what these all mean with the help of an example. So if you are not taking the discount, okay, and not making the payment, okay, that means you're borrowing the money from supplier, okay, for C minus B days. So here C is 30 and B means 10. So 20 days. Okay. So foregoing the discount for prompt payment. That means if you were to make the payment promptly, you would have taken the discount. Or if you not making the payment promptly, that means you want to go ahead with the credit terms. Okay. If I make the payment promptly, never I will get this discount, right? See, first and foremost thing is day one. If I make the payment on day one, will I get discount? I will not get. If I make the payment in day 10, definitely I'm going to get 2% discount. If I make the payment in day 30, what is going to happen? No discount. Day one, I'm not getting discount in the sense the charges for the customer who is taking the goods on cash basis and credit basis usually differs in the trading concerns, right? So here you may expect a premium price if you're going for credit terms. Let's see the practical example here which is given, which will make us to understand it in a more better way. So foregoing the discount for prompt payment amounts to borrowing money from supplier for this 20 days of at an effective annual rate. We can calculate as follows. So this is the formula for effective annual rate. Don't go for any derivation. No need. CFA Institute doesn't require you to go for derivation of formulas. Just remember it. And there are certain exams they give like ACCA and other exams to give the formulas also, because today all the formulas whatever the people are using in the computers are doing that work, right? So effective annual rate of supplier financing. A supplier offers 2 by 10 net 30 terms. Oh my God, I gave this example, but I didn't know that question also has the same terms. The bank interest is 8%. That means bank will pay you 8% interest, boss. Okay. Which source of financing would the company prefer? Oh, I mean say supplier is offering you 2% discount if you make the payment in 10 days. And if you make in 30 days, you won't get any discount. Bank interest rate is 8%. Okay. And they're asking which source of financing should you prefer? That means if you want to pay the money to supplier, if you want to make the payment to supplier, either you can accept the supplier's terms of payments. That is, if you pay in 10 days, you get 2% discount. If you don't pay, you won't get. Or else you can take money from bank as a loan and make the payment to supplier. If you do that, the bank is going to charge you 8% interest. Things are very clear, right? Financing is for how many days, boss? Financing is for 20 days. Why 20 days? If you make the payment in 10 days, you get 2% discount, right? Yes. And if you delay, it's going to be like whole 30 days. So why the financing is for 20 days here? Hello?
So because in a month there are 30 days and is also providing 30 days until payment and 10 days we are getting off discount. Other than that, if we see we have 20 days of financing.
Yeah. See, supplier is offering this, bank is charging this. Which source of financing should the company prefer? So if they are making the payment in 10 days, will they go for financing? Will they go for financing? No.
No,
If
sir,
they are
they'll get
not
it.
making the payment in 10 days, if they are delaying the payment for 30 days, then they will definitely take the loan, right?
Yes, sir.
Whatever the loan they are going to take, they will decide after 10 days or they'll decide on the first day. Come on.
So they'll decide on the first day,
See, I'm giving you credit, right? And the option is with you to pay the money in 10 days. So will you take the loan on first day or on 10th day you will decide?
On the 10th they will decide.
That's what, if you are making the payment in 10 days, you won't take the financing. If you're not making the payment in 10 days, definitely you will be taking the finance and you'll be making the payment in 30th day, and that is for 20 days, right or wrong?
Right, sir.
That's what. So 10th day is the crucial day to decide. So the financing is going to be for 20 days. Isha, did you understand?
So I think she's not there in the meeting.
Net connection. Yeah. Now did you understand, Bhargav?
Yes, sir.
See, 10 days you can make the payment in 10 days. You have the option. If you are making the payment in 10 days, then definitely you will not be taking the finance for that time, right? Till that time period, finance options are something which which you will not be considering, because there is no pressure on you to make the payment, right? Hello?
Right, sir.
See, the option has been given to you. It's you who has to decide to make the payment. And
Yes,
if
sir.
you are making the payment in 10 days, you'll get 2% discount. But if you are not making the payment, then you will wait for 30 days, right? And for those
Yes.
the 30 days for making the payment, you have to take finance, right? Now,
Yes.
yeah, because you will avail the discount only if you have the benefit. So effective annual rate of supplier financing. So this is the effective annual rate, okay, for 20 days financing. The cost of implicit supplier financing, which is 44.6%. This is 44.6. Just a second. Effective, this is annual rate. Did you understand? 44.6%.
So what is like annual rate is
Annual rate for the entire year they have calculated 1 year.
okay. Yes.
So the cost of implicit supplier financing is 44.6, and if you take the bank loan, it is
8%.
8%. So 44.6 is way higher than 8%, right?
Yes, sir.
Right. So supplier is taking a lot of, like benefit from you. He is deriving a lot of benefit from you. So the cost of implicit supplier financing is much higher than the cost of implicit bank financing. Company should borrow from bank at 8% to pay the invoice within 10 days. That's it. Okay.
Sir, but I still have a doubt.
Yeah.
So this 44.6% is the discount. Actually, that is a 2 days
Yeah.
2%
That is
discount
nothing
that we
but,
are getting.
sorry.
The 2% discount is what we are
Yeah,
getting.
foregone discount. The cost of not taking the discount.
Oh, okay, right.
Cost of not taking the discount.
Yes, sir. So then how are we implying that uh, we have to take 8% loan and then pay?
Because see, if you are not taking the discount, it is costing you 44.6, right? But the bank is giving you loan for 8% interest. So which is
Yes,
the cheaper option for you?
taking the discount.
That's what. No, taking the bank loan, right?
So, but oh, okay, so this is a scenario where we don't have the cash to pay immediately, and that is why we will take the loan and pay.
Just a second. Just a second. Yeah. What did you
Yes,
ask?
sir. I asked like so we are currently looking at a scenario where we do not have the cash to pay immediately. That is why we are taking a loan at 8% and paying it to the supplier and availing the 2%
Yeah,
discount.
see, the point is if you have taken credit, that means you don't have money to pay.
Yes,
You're
yes,
you're waiting for certain period to make the payment.
yes, sir.
Understood?
Understood.
That's what. Shall we
Sir,
move
and
forward?
the formula, we have a -1 over there at the end.
Where is that?
EAR after 365 by 20.
Okay, -1. Okay, just do the calculation once practically.
Yes, sir, I was checking that.
Yeah, once do this.
Sir, it's the correct answer only.
Yeah, okay. Shall we move
It's a
forward?
-1 over there.
Yeah, -1 it should be there, yes.
Yes,
So effective annual rate of supplier financing. That means if you are taking the credit from supplier, okay. Point is, if you make the payment in 10 days, you'll get 2% discount. But if you're planning to make the payment in 30 days, that means for additional 20 days, you are taking credit or finance from the supplier, right?
yes,
They have given 10 days time to you and they are giving some good discount also. Cost of not taking the discount is a separate concept. I'm not going with that right now. It's a separate concept. The how you have to infer. They're asking effective annual rate of supplier financing. So the supplier financing will happen for what? So they have given the statement foregoing the discount for prompt payment amounts to borrowing money from supplier for C minus B days. So foregoing the discount for prompt payment amounts means if you make the payment on the on the day one itself, will you get discount?
no, sir.
And that means you are not making the payment to the supplier. Okay. And if you are not making the money payment to supplier on 10th day, that means you're going to borrow money from supplier for the additional 20 days from 10th day to 30 day,
Yes, sir.
right? Now this is clear.
Yes, sir.
If you make
So,
the
but
prompt payment, if you make the prompt payment, no discount. If you make the payment on 10th day, you get 2% discount. But if you are not making the payment on that day also, then 10 to 30 days, the difference is 20
yeah,
days. That means you're taking
yes,
credit from supplier for 20 days, right?
yes, sir.
So that is they are calculating as per compounded basis. So that is coming around 44.6. You understand,
Yes,
if you don't make the credit card payments, how much they're going to charge you on daily basis?
yes, sir.
When after 45 days, if people don't pay credit card payments, it's very heavy interest. Everyday basis, they'll charge you on everyday basis. Understood?
Yes, sir.
So this is what is 44.6. It is better to borrow money from bank, right?
Yes, sir.
So company could borrow from its bank at 8% to pay the invoice within 10 days. Why? They don't have
Yes.
money. That's the reason why they have gone for credit. So they can take the bank loan and try to make the payment in 10 days so that they may get 2% discount also. Right?
Yes, sir.
Everything is
So,
all right.
but why would the supplier give credit and discount and not give cash discount?
See, 2% discount is given. If you make the payment on day one, there is nothing like discount, right? Why will you make the payment on day one? If you make the payment on day one, then it's a cash sale. It's never a credit sale. You are going for
Yes.
credit sale. Why? Because you don't have cash. Point number one. Since
Yes.
you don't have money or cash with you, you are asking for credit from your supplier. So supplier told, no problem, I'm giving you 30 days time. But if you make the payment in 10 days, I'll give you 2% additional discount. Now you have to decide whether to take the discount, whether to
No, sir.
extend.
I understood this. I understood this.
Yeah.
My doubt is why will the supplier give us a 2% discount on credit sale and not give us a discount on cash basis, cash discount?
See, the thing is here, there is no matter about cash sales, right? If it is a
Yes.
cash sale, you can have good negotiation from your supplier.
Yes, sir.
Of course, when you are making the prompt payment, that's a different case. It is the point. The point here is about financing. Okay, it is only
Yes.
targeting that segment whereby the credit is, like more often, like considered. So
Okay.
if credit is considered from supplier, 2% you can get discount if you make the payment in 10 days. You don't
Yes, sir.
have money. So now you are thinking of taking the finance, bank finance, and making the payment in 10, making the payment or taking the supplier finance. So 10th day is the deciding factor. If you don't make the payment for in the 10th day, then you are taking, then you have to make the payment on 30th day, right?
Yes, sir.
So till here you have the benefit you can avail, but you are not availing the benefit. Then extra 20 days you are asking credit from supplier, correct or wrong?
Correct, sir.
For which the cost you are incurring is 44.6%,
Yes,
which
sir.
is annual rate. But annually bank is charging only 8%. So you can take
8%.
the loan at the rate of 8% and make the payment in 10th day and get the 2% discount. That's it. Shall we move forward?
Yes, sir.
Cash conversion cycles vary by industry, of course. For example, pharma industries have long CCCs because they maintain inventories of high margin drugs to meet unexpected surges in demand. So where inventory is high, like your stock conversion period is high. So if your stock conversion period is high, your cash conversion cycle is high, correct?
Yes, sir.
Actually, the companies should try to lower it. By contrast, airlines have very less because most of the sales they do is on spot or on cash basis maximum. Very less is what they will be going for. I don't see any kind of credit, but because of most their sales are prepaid, they do not keep significant inventories at all. So analysts should use CCC to compare companies within the same industry or to track a company's performance over time. So if you are comparing the cash conversion cycle of any company to invest your money, so don't do that with airlines and drug companies. You take two airline companies, SpiceJet and Indigo, and see their CCC. You take GlaxoSmithKline and you take Cipla and you compare their cash conversion cycle. Did you understand? And then you can decide which company is like maintaining a less cash conversion cycle or which dependent on less credit, right? Now,
Yes, sir.
in addition to cash conversion cycle, overall levels of working capital can indicate how efficiently company manages its liquidity. Of course, like at what level of $1 of working capital finance they are able to generate, or how much dollars of sales. It depends. To compare companies of different sizes, analysts calculate working capital as proportion of sales. That's what I said right now. Sales upon working capital. So $1 of working capital is giving me $10 of revenue. $1 of working capital is giving me $7 of revenue. Which is better? This is better. Now, because the ratio varies by industry, care should be taken to compare firms in similar lines of business? Of course, as we really know that right now we've discussed, we should be very cautious. Total working capital is current assets minus current liabilities. We already know this, so we are not discussing. We're going forward. Okay. So explain liquidity and compare issuers' liquidity levels. See, liquidity is nothing but how much liquid assets you have, or what is something like something which can be converted into cash, how much sooner. So if I speak about land, is it a liquid asset? No, it's a illiquid asset. Because the liquidity is very low for this. It will take long time for it to convert this into cash, right? But if I say cash or cash equivalents, they're all almost liquid assets. So liquidity is nothing but how much time, how much things are very easy to be converted to cash, or how much it is near to cash. That's it. So inventory happens to be the most tangible current asset, and it is very less liquid current asset, right? Account receivable can be a more liquid current asset than inventory. So because it can be converted into cash more sooner, of course 30 days. And because we don't extend credit terms to our customers at times, we want to collect the money as soon as possible. Now you'll speak about bad debts. That's a different case. Inventory may take more longer time to convert into cash at times, and sometimes it may become obsolete and scrap, and then we lose money and show losses in case of inventory obsolescence. For a corporate issuer, liquidity refers to availability of cash and other liquid assets to meet its short-term obligations. So primary liquidity sources include cash and marketable securities on hand, bank borrowings, cash generated from business. Long-term solvency of company depends upon long-term liabilities. Everyone knows, or long-term debts, right? So if a company has to be solvent enough for long-term, so long-term solvency of company depends on its ability to generate sufficient cash from its business to service its liabilities, whether it is able to pay its liabilities or not on time. That will decide the solvency of a company. If the company is failing to meet its obligations, paying the principal and interest amount, then definitely it is less. There's more chance of it becoming insolvent. Analysts evaluate a company's liquidity management primarily by reviewing its statement of cash flows, which we'll study afterwards in the financial analysis book. Companies generally rely on primary sources of liquidity, which we discussed right now, which is cash in hand, cash at bank, or cash equivalents, marketable securities. However, if needed, sometimes company can go for secondary liquidity sources. That is nothing but last resort. Sometimes what they can do, they can sell their assets. They can not pay dividends to their shareholders. These are extreme things. Okay, they can delay capital investments or reduce investments, or they can go for additional equity shares, and they can try to use that funds to run its operations. They can restructure debt and extend the maturity. That means they may ask more time from the bond holders or the banks to make the payments. Some in COVID times also people have approached banks to extend maturity periods because they were not able to pay, and it happens. Bankruptcy protection filing, which suspends the need to service the liabilities, because if you are declaring yourself bankrupt, then you may get the protection from the authorities, and no one will bully you, or kind of pressurize you to make the payments, or use different terms, or go to some extent whereby you may have some threat from them. So using secondary liquidity sources sends negative signals to market, because that shows company has certain issues. So primary liquidity sources are better, despite they are costly. No, secondary liquidity sources are costing much to the company's reputation. Yes. Company, see, whenever you have your cash, you can try to invest in your business or use for your business purpose, but it has an opportunity cost. Instead of investing somewhere else, you are investing in a business. But okay, because you think that is the best one, that's why you're doing that. Company's cash conversion cycle may vary by time of the year. That is seasonality. That means some businesses may have less cash conversion or more cash conversion cycle during certain seasons, like woolen clothes, because they depend upon certain seasonal businesses. Okay, and because at that time you may extend credit to your customer for more sales, and that may increase your cash conversion cycle, maybe. And as the business conditions change, example, a sudden dip in demand for company's product will increase inventory and increase the DOH. What is this DOH? Debt collection period, right? Hello.
Yes, sir.
So they are using a different terminology, but DOH, days of inventory on hands, is it that? Yeah. So that is stock conversion period because they have a different terminology used here. So what will happen if your goods are not sold more promptly? You may have more inventory in hand. That means stock conversion period will be what? Your stock conversion period should be like more or less.
Less.
Sorry.
Less.
You see, if your stock conversion period is 10, if I take if your stock
Okay,
conversion,
it should be.
there are
It should be.
there are two ratios here. That is like one ratio is stock turnover ratio, that is 10, and stock conversion period is 36.5 days. You want this to be high and less number of days. So it is, yeah. So stock conversion period should should be less. So what happens? Business conditions change, sudden dip in demand for companies product. Companies products are not getting sold, taking more time to sell. So that will increase your stock conversion period. It is not good, right? It's good or bad?
It's bad.
Very good. It's bad. Now, so because you're taking more time to convert your inventory into cash. So cash and marketable securities serve as buffer to meet companies' obligations when there is a deviation from normal cash conversion cycle, of course. And this excess cash has a cost because it represents capital not invested in business. So I spoke about opportunity cost right now. So instead of you investing that money into your business or some other investments you would have done, you have to use that for your for to you have to use those funds to save your business from crisis. But inadequate liquidity can result in having to rely on higher cost secondary sources. That is even more worse situation for your business. So can we go for this question, cost of liquidity? So Drake
Yeah.
Corporation has a sudden need for liquidity to meet its payroll at the end of the week. Companies' sources of liquidity and their cost are shown here. So sources are cash and marketable securities, fair market value, liquidation cost, 0. Of course, there's no cost to liquidate this one. Immediately you can sell in the market. Negligible cost you will be incurring. Brokers may charge very less. Inventory and receivables liquidation cost is 15% because it may, like collection and all, it will take time, and selling that inventory in the market at lower cost can cost you. An empty warehouse you have to sell, and the liquidation cost can be very high because when you want something to sell, you are not you the bargaining power of the customer may be high and your bargaining power may be less. Correct or wrong?
Correct. Correct.
Yeah. So bargaining power, if it is in our side, we may always benefit. Calculate the total proceeds from all sources and the cost of liquidity in dollars and in percentage. So cost of liquidity is discount to fair market value from which an asset is sold due to need for immediate liquidity. Yeah. So cost of liquidity is nothing but how much you are removing from your fair market value if you are selling the asset in the market for immediate liquidity. Are you understanding, Bhargav?
Yes, sir.
Otherwise, you would have waited for normal time and you would have taken some good time to sell that asset at a higher or premium price. But due to certain requirements that you have some pressure from your investors or someone to whom you have to make the payments, you are selling it at lower cost or a discounted value. So these are the fair market values. These are the liquidation costs. So the liquidation cost is 15% of inventory lost, $30 from this, and here $90. So the net proceeds what you are getting is this. So out of 600, 120 lost and 480 you are getting. Correct? So cost of liquidity
Yes.
is how much? The cost,
120.
yeah, cost what you have incurred upon the fair market value, the sales price, selling price. Okay. So
Yeah.
loss by selling price is giving you cost of liquidity 20%, right?
Yeah.
So you can also calculate 600 into 0.80 will give you 480. That's what. Shall we move forward?
Yes, sir.
Now, factors affecting liquidity: an increase in cash conversion cycle reduces issuers' liquidity. The cash conversion cycle, yeah, we should not have a higher cash conversion cycle. Can increase due to drags or pulls in liquidity. Drag in liquidity occurs when cash inflows lag. That means you are not getting your inflows on time. This is when the customers are taking lot more time to make the payment to you, or you're not able to sell your inventory sooner, right?
Yes, sir.
So when your collections slow or you're not able to sell your inventory in the market, you are struggling to do that. There is drags on liquidity, and when you're able to accelerate that, the drags on liquidity will be less. Correct? Now,
Yes, sir.
pull on liquidity. So drag on liquidity is adversity, not a good condition, adverse condition. So it is only possible if there is a like slow, slower sales of inventory, and like more time taken to collect from customers. And next thing, pull on liquidity occurs when cash outflows accelerate. This can occur when suppliers reduce credit lines or demand faster payments. That means these two are not good. Here you have to make payments more sooner because suppliers are not accepting to give you more credit period, right? So this can affect
Yes.
your liquidity or not.
Affects.
So now all this is done. I don't think we have to discuss ratios, Bhargav. Already done, right? Can I give you this topic as homework?
Yes, sir.
Okay. So this is homework for you. Do this question. We'll go for the next and last topic. Describe issuers' objectives and compare methods for managing working capital and liquidity. Working capital management seeks to maximize firm's profits. Yeah, if you manage your working capital properly, then you have to ensure that uh, whatever the standards we have seen in the ratios, like whether it is collection of your money from customers or selling your goods to the customers, more often, or increasing your stock turnover ratio, then what would happen is you may be able to maximize your profits, or instead you may decrease or reduce your losses, right? So working capital management seeks to maximize firm profit while ensuring that sufficient liquidity is available to maintain firm's operations and meet its obligations, right? That is what in working capital, current assets and current liabilities are elements of working capital. Here what we are trying to do is we are trying to manage it, and the agenda is always to maximize the profits and also maintain sufficient liquidity so that the business operations are smoothly dealt with, and everyday operations, whatever you have, you can smoothly run your affairs. So firms may choose to hold more short-term assets which offer lower rates of return to ensure that sufficient cash is available to service its obligations. So you may try to hold more short-term assets because it may offer lower rates of return, right? Correct or wrong? Because there
Correct.
is less risk on this. Correct or wrong?
Correct.
Long-term assets are giving you more returns in longer period of time because risk involved in them is high because they are less liquid. And the firms may choose to hold more short-term assets to ensure that sufficient cash is available to service its obligations. Yes, and the firm can also choose to finance its working capital using short-term loans when time requires, which can be cheaper than sources such as long-term debt and equity because risk is more in this. So more cost, and this is the most costliest one because at the end, all the costs in the business, whatever we have, ultimately the owners are the one who are going to bear the maximum cost. Okay.
Yes, sir.
However, the firm must consider the risk of being able to roll over short-term debt at reasonable cost. That means whenever they require, they can make the payments and again take the debt, make the payments and again take the debt. Like credit card, we try to roll over, right? When we take credit of 50,000 from our card and make the payments, immediately on 45th day we have to repay that, and again we'll get that credit of 50,000. So in that way, what will happen is, on time, if we do these things timely, it may reduce our cost. So in analyzing different approaches to working capital management, it is important to control for size differences between companies. We do this by calculating companies' relative amounts of loan, long-term versus short-term assets as a proportion of sales. So what they do is they always, if they want to check their working capital, whether it is intact or not, they try what they do. They try to calculate companies relative amounts of long term versus short term assets as proportion of sales. That means how much long term assets they have and how much sales they have made, how much short term assets they have and how much sales they have made. They try to check that. A conservative approach to working capital management is for the company to hold higher amounts of short term assets. This is very conservative, right? They are holding lot of short term assets relative to long term assets and finance the working capital using long term sources such as long term debt and equity. So what is conservative approach? They want to hold short term assets, correct? Because they're looking for short term benefits and they want to finance their working capital from long term debts or equity. Are you understanding, Bhargav?
Yes, sir.
So what they want to ensure is the people who are much more conservative, they always look for profits in 1 year time or short span of time, and they don't think for the long term. So what they do is they hold much of short term assets or more liquid assets, more and more liquid assets instead of long term assets. Okay, like instead of going for a land and waiting for 10 years, he may go for mutual funds or SIPs, which can give immediate or instant returns. That is what a conservative person always thinks, right? I should always have my returns in my hands and my money should be in my hands, right? This is a
Yes, sir.
liquid cash, correct or wrong? Now, benefits of conservative approach include some permanent working capital with less need for rolling over. Yes. So what they are having is, just a second. See, what is the benefit of conservative approach? As you're holding more short-term assets, okay, and you want to finance your working capital with long-term sources like debt and equity, you are looking for some permanent capital. And long-term debt and equity is not a small amount; it's a very big amount. So there is no need for rollover also, right? If you're using cash, whatever you have, or short-term assets, whatever you have limited amount of that, correct or wrong? So
Yes.
you may pay that and again you may look for rollover, right? Now, greater flexibility during market disruptions and a high probability of meeting short-term obligations. So these are the benefits of conservative approach. They want more permanent capital in form of long-term debt and equity. They want to fund more of their working capital requirements with long-term debt and equity, and they want less rollover. They want more flexibility during market disruptions. That means when market is in recession or some market adversities are going on, and they always want to make sure that whatever their short-term obligations are there, they should have enough funds to settle that. However, conservative approach results in higher cost and lower profitability because long-term debt and equity are very costly. Okay, because for very long period of time your assets like you have taken the money from people, and as the duration increases, as the time increases, and for more time, if people's money are with you or bank's money is with you, people's money in form of bonds and bank's money in form of loan, of course both are loans. So they want more premium for that or not, for higher risk. See, if I am giving you a loan for 1 month or 2 months, the interest what I charge is something like 10%. You are making the payment for 2 months. But if it is for 5 years or 10 years, you're making interest payment for higher period of time or lower period of time.
Sorry, sir.
See, short-term debts are costly or long-term debts are costly.
Long-term debts are costly.
Why long-term debts are costly? Because the
So
money
because
is with us for long period of time, right? So
yes, sir.
as the risk is high for the people, because in long term lot of adversity can happen, lot of issues may crop up, more chance of bankruptcy can happen, market fluctuations can disrupt my business activity or anything. So they want more premium, so it is costly. So if conservative approach is followed, the cost is high and the profitability will be less. Additionally, long-term lenders may impose operational constraints such as minimum interest coverage ratio. That means the long-term lenders may ask company to maintain a particular interest coverage ratio always. Otherwise, they have certain covenants. Covenants are nothing but conditions. If company is not able to maintain let's say interest coverage ratio of 8 or 10 times, then they may impose certain restrictions or they may demand their money. So such kind of conditions would be there. Now we have just discussed about the conservative approach, whereby more of long term debt or equity is utilized for meeting the working capital requirements rather than short term assets, and this eats away profitability, and the cost is high to the company. Okay, and more restrictions as well. Now aggressive approach would be to hold relatively lower levels of short term assets and working and finance working capital using short term debt. So what are you doing
We are
here? You
taking
were maintaining, yeah, here you are maintaining what? Higher amount of short term assets. Short term assets can be short term investments, correct or wrong? Can this be a short term asset or not? I said na, SIP, mutual funds. Hello.
yes, sir, they are
Hello.
marketable securities.
Yeah. So if you are using, if you're having more short, because you're looking for short term profits, returns. But what about aggressive? They would hold lower levels of short term assets and finance the working capital with short term debt instead of long term debts, right? So they may hold, they are very aggressive, very risk taking people. They may hold more of long term assets. They may invest heavily in some long term assets and use less short term assets, and they may not fund with more of debt and equity or long term debt or equity. They may fund more with short term debts because that is their nature. And like what will happen if you are using short term debts for purchasing more inventory, or like more of current asset, more of long term assets or something. See, we discussed right now, they hold very relatively low levels of short term assets. That means they want to put more money into long term assets, right or wrong? And for that, what they are doing, they are taking what? What are they taking?
Short term debt.
Yeah, so if you take short term debts and you buy more of long term assets, then what? Do you think it will be sufficient? You have to take more debt and you have to just roll over again and again and pay a lot of interest, correct?
Yes, sir.
It is, see, it is something typical of aggressive approach. I know aggressive approach is, risky one, but there can be some benefits also if you take risk, right?
Yes, sir.
What is the benefit? Short term loans are cheaper. Okay, they are cheaper, I understand, but if you take loans and put heavily on this, okay, some money you put from your side, some money you take loans and put into this, or again and again you take money, because short term debts are limited, right? And you have very you are using a lot of overdraft or short term loans to fund your working capital needs. Okay, you may buy also and you may use also for your working capital needs. So the benefit of aggressive approach is lower cost, because short term debt is less costly, and but it is risky, right? Because as you take short term debt, the pressure on your company is to make the payments earlier or later. As you take short
Earlier.
term debts, the pressure on your company is to make the debt payments earlier or later.
Earlier.
Earlier. So again, it is a pressure on your company to perform well, right?
Yes, sir.
If you're not a profit making business or loss making business, then it will be very tough for you to make these payments very early. See, if you want to see, if you are opting for housing loan and they're giving you 30 years time, and you're taking a short term loan, and here the EMI is 20,000, here the EMI is 1 lakh. Okay, and you have to make the repayment in 3 years. Now you tell me, 30 years, 3 years, 20K, 1 lakh. You tell me which is very risky, this or this?
30 days, 20K.
This is risky. This is more risky, right? Because
Yes.
you have to constantly make the payment of 1 lakh. So the pressure is very high on you, right? This is costly. This is very
Yes.
costly because for 30 years, if you are making 20K
Okay.
payment per month, I
I looked
understand
at
the amount
30
of
days. I didn't think that was 30 years.
30 years. Yeah. The amount of interest you're paying is for 30 long years. It's very
Yes.
high cost. But here you are paying, making the interest payment less. The principal element is high, but this is a very pressure mongering one, right?
Yes, sir.
You cannot afford to incur loss any point of time. So risks are, but its risks are failing to meet business obligations and vulnerability to market disruption. So see, if at all this is the thing you have considered and there is a COVID lockdown, what will happen? The businesses have to temporarily shut down. And then can you make the payment of this heavy amount? Imagine.
Yes.
That's what. Moderate is nothing but it is a balance of the aggressive and what we discussed, moderate the aggressive and conservative approach. So moderate is something from conservative and something from moderate. So moderate approach seeks to find a middle ground. Permanent current assets are funded using long-term source of capital, while current assets are funded using short-term source of capital or short-term sources. Okay, so what we discussed in conservative, what were we doing? We were having more short-term assets, right?
Yes, sir.
And we were and what we discussed about it, higher amount of short-term assets and relative to longer term assets. We are maintaining long-term assets, but when compared to short-term assets, very less. We want more profits very sooner, right? And
Yes.
whatever the working capital we were funding with, working capital was funded with long-term finance. This was conservative. In aggressive, long-term assets we want more rather than short-term assets, right? And
Yes.
here the funding we are doing with short-term funds. Here moderate long-term assets, long-term capital, short-term assets, short-term capital. Finished. Short-term sources of funding. Correct or wrong?
Yes, sir.
That's what. So here in moderate, they are applying their sense. If they want long-term assets, they are going with long-term source of capital. If they want current assets, they want funding or finance for current assets, they're going for short-term sources of finance or capital. Now, what are the short-term liquidity sources available? So firms should maintain a variety of alternative sources and evaluate the cost of each source. That's what they're saying. While securing sources ahead of time to meet spikes in liquidity needs. See, every company should look for variety of alternative sources, right? They should not stick themselves to only one type of finance. If I'm taking overdraft, I'm comfortable. It's not like I should be comparing different sources and see where I can get least cost finance. Isn't it so? And
Yes.
whenever I have needs of liquidity, I should always have enough funding available with me. So that's what they're saying. While securing sources ahead of time, that means you should not wait for the last moment and go for finances. You should always see at what times in a year or during what, like you see Diwali or festive season, many businesses require a lot of funding. So whenever there is a spike in liquidity needs, you should ahead of time, you should be trying to arrange them or secure them. Factors that affect a firm's approach to short-term funding include the following. So what factors can affect the firm's approach towards its short-term funding or arrangement of short-term funding? First of all, the company size. Smaller firms have limited options. Company's creditworthiness is checked always before funding can be given to it. Then they have to undergo a lot of legal procedures, right? Because a
Yes.
lot of protection for lenders and and developed economies will with well-defined protections. So you know, in United States or UK or developed countries, you can take loans, but you should provide a very sound or strong protection to the lenders, right? Offer more funding alternatives. So here it's not only bank you can approach public also. So if you are able to convince them that you are going to repay the money to them and going to give them protection, then you have a lot of alternatives available. Regulatory concerns firms in regulated industries such as banks and utilities. So you know, banks in India are regulated by RBI. So they have certain restrictions how much they should take or how much they should always maintain a cash reserve ratio or etc. Have restrictions on funding sources as well as amounts raised. Yeah, banks cannot give 100% funding, right? If you want to approach for home loan, you should have 25% down payment and 75%. In Europe and other countries, only 5% down payment is okay. And banks should always maintain a cash reserve ratio. That's what regulators say to them. So they should always maintain 20 or 25% of ratio with them to always comfortably meet their operational needs. That may also restrict them to give 100% funding. That is from banking sector perspective. This is from the individual's perspective. And underlying assets that serve as collateral on loans. So this is what, if you have, you can get the funding easily. Okay, Bhargav, since there was a lot of theory, I did not want to miss even a single line. I wanted to explain everything. I know I'm not teaching you from curriculum review, but I don't want any leaf to be unturned. So I'm covering every point. And because see, where students lack is theoretical questions. Practicals, any XYZ can do, but theoretical questions, they twist like anything. So if you don't have proper concept or strong concept, then you may not be able to comfortably solve the theory question. So that's the reason why I'm making point to explain every point. Okay.
Yes, sir.
So this chapter is done from corporate issuers. So let's discuss tomorrow what we are going to take. So tomorrow's chapter is working capital investments and capital allocation. Okay, Bhargav, this is done.
Yes.
Since this is done, I want you to finish the quiz questions, and I'm going to send you the PDF of this. Okay.
Yes, sir.
What is the status of ratios and TVM? Have you finished them?
So the ratios I completed about 45 to 50 questions.
Okay. And
And
TVM?
TVM I start after finishing ratios tomorrow.
But
Tomorrow
this
I
is
have a half day, so tomorrow I'll finish ratios and then I'll start TVM.
okay. Okay. Please do it fast because you're going to get third PDF also today. Okay.
Yes.
Okay. Okay then, Bhargav. Okay then. See you
Okay,
tomorrow.
sir.
We'll take the class tomorrow. Thank you. Bye.
Sir,
Yeah.
sir, about the textbooks I was asking.
Oh my God. Actually, yesterday I was able to about to dispatch. Tomorrow morning I'll dispatch your books. Surely I have the books with me only. The only thing was I went to the courier's office. They have shifted, it seems. This what courier we used DTDC. DTDC. So
Oh,
I have got the address. Tomorrow I'll go to them and I'll dispatch your book morning.
okay.
Okay. It will
Yes,
be
sir.
done by tomorrow, and I'll send the this thing to you, acknowledgement to you.
Yes, sir.
Hmm?
Thank you,
Okay.
sir.
Thank you so much, dear. Thank you. Bye bye. Good night.
Bye.